Well, hello again everyone. Thanks for joining me for a chat again about the Aussie stock market, and just having a look here at a chart of the XJO over the last 6 months, and we're down 6% across that period. We had a couple of goes at getting through that 7,600 level, didn't make it. And in here, of course, we've had interest rate rises, one over here at the start of May and then another one at the start of June, and that has led to some negative momentum, certainly as a result of those interest rate changes. If we look at across 1 year, we've had actually 3 goes at trying to get through 7,600, and so we haven't made it. Call that a triple top, I guess. And I suppose the question we're all asking is, where to from here moving forward? I mean, over the last 5 years, 20% growth, sort of roughly about 4% a year, I guess. That's at a simple interest rate, compounding probably like about 3.5%, add on some dividends of 4%. So the market's grown around about 7.5% on average per year. So it's doing okay, but we're now facing a challenging environment. Down here we had COVID, now we've got this environment of rising interest rates, well it certainly appears that way. And the question is, are we going to go up and sort of ignore the pressure of those interest rate rises? We're going to sort of tread water for a while, just go sideways, or is it going to be a little bit of a capitulation and we're going to be heading south from here on? Well, I did get a comment after my most recent video about the solar panels, asking me to check out Finer Market Points with Gary Glover speaking there. And I did that, and I did find a video. It says it's 1 month ago, but actually it's 2 months ago, and it did pique my interest. How do rising interest rates really impact the markets? And I do have a little bit of time for Gary. I used to watch him when Your Money, Your Call was on Sky Channel. He often made a lot of sense, so I thought it'd be worthwhile having a listen to what he had to say. I'll put the link to this particular clip in the video description. The particular section that covers the chat about interest rates begins at around about the 20-minute mark, goes for about 10 minutes. And in that chat, he did produce this particular chart. It is interesting to note what in general happens to markets, this is historically speaking, in varying interest rate cycles. And so he was pointing out that if there is no tightening, so after an interest rate rise, and this is the Fed in the US, if the Fed makes an interest rate rise, but then after that makes no more rises, then the stock market, generally speaking, tends to go up. And those cycles he's got listed here is to 68, 71, 84, and 97, producing about 25% growth over the 24 months following that rate hike. Now, if they continue the rate hike cycle, but in a more slow and measured way, as indicated in these particular periods here, then in black we find that the market still manages to go up. So it can actually absorb that pressure, provided the interest rate cycle is not being increased at too great a rate. The market grows on average at a slower rate, 12% roughly over that 2-year period. But if you increase, or if the Fed increases interest rates at a fast rate, and that's certainly what's going to be happening, it would seem, then the very best the market is able to do is to head sideways, and there are periods within that where the market does tend to head downwards. And so he's basically pointing out that historically speaking, we should be maybe expecting that at best moving forwards, the market could be heading sideways, and that movement upwards is far less likely than a sideways movement or a movement downwards. Well, I've just been checking lately on the effect of these interest rate changes on the PE ratios, and I've spoken about it a little bit on YouTube and to a much greater extent on my Patreon page. But let's have a look at the Aussie 300 index over the last 3 months, from March the 10th through to June of the 10th. Now, back on March 10th, interest rates were at 0.1%, and here we are now sitting on 0.85% as at June of 10, the average PE ratio for individual stocks has fallen from 93 down to 80. And that is not because earnings have gone up. It's because the prices of the stocks have gone down, as I mentioned before, over the last little period by about 6%. Now, you might say, well, why is it so large when the market average PE ratio is 15.84? How can you have stocks with an average PE ratio of 93 or 80 as it is now? Well, it's to do with the way averages work, and in amongst that ASX 300 index, there are many stocks with very high PE ratios, and these 6 are the highest P ratios of all: GrainCorp, NextDC, Transurban, Xero, Polynovo and Star Group. And have a look at Star Group, PE ratio 11,199. Those are extraordinarily high values. That explains why on an individual stock basis the average is so high. But if you weight it according to market weight, and you start looking at the fact that companies like BHP and Rio, which are very large market cap but have a low PE ratio, that tends to moderate the market PE back down to around that 16 level, which is historically quite low. But having a look at the performance over the last 3 months of stocks with varying PE ratios, there's a trend sort of appearing. I think it's a clear trend. The stocks with low PE ratios, and I've mentioned this before, have been outperforming the stocks with high PE ratios. And over the last 3 months, the low PE stocks have fallen by an average of 1.89%, but the stocks with a high PE ratio have fallen by an average of 14.72%. So a marked difference between the two different types of stocks if you're just considering PE ratio on its own. And if you actually go and look at the companies that don't have any earnings whatsoever, there's quite a number of those, about 50 or so I think, could be more. Their average share price change is negative 17.83%. So doing even worse than companies with the high PE ratio. Now, if we're looking at the companies that haven't done very well over the last 3 months, again, a clear picture developing here. Up at the top here, Zipco, Megaport, which were market darlings about a year or more ago, losing 63 and 55% over the last 3 months, and coming all the way down to the bottom. Breville Group at 32, OML, I'm not sure what that is, that OM Holdings perhaps. But whatever the case, these are the worst performing stocks over the last 3 months. And if you look at the PE ratios, you'll notice that more than half of them don't even have one. In other words, they have no earnings. So the market has decided they just don't want to be invested in companies which might have a good story but don't have the earnings yet on the board. And for those that do have earnings, there's quite a number there with elevated PE ratios. PPK at 99, EML 34, that's not so bad. Temple & Webster 53, Johns Lyng Group 57. And that's despite the fact that it is just shooting the lights out with its earnings growth. But the market still is selling it off. Its PE recently was more than 100, now down to only 57. Aussie Broadband sitting at 99. If you look at the stocks that have done well over the last 3 month period, quite a number of them, of course, are from the mining space and the energy space. Got New Hope, Whitehaven Coal, what have we got? Min Resources. I'm sure we could find some others in here. AGL was having all that takeover speculation about that. Beach Petroleum, Fortescue, and so on. So the energy space in there. But if you look at the PE ratios, very few are companies that have no earnings, and lots are companies with much, much lower PE ratios. So there's definitely a trend there that we need to be taking account of, I believe. And I do talk about that in much more detail over on the Patreon page when I reference the 3 strategies that I've developed. Now, to be fair, those strategies are not performing well because many of the stocks within the strategies do have a quite high PE ratio. And it's something that I'm certainly considering adding into the mix when just making my decisions as I go forwards. But of course, that's my decisions. And the questions that you need to be asking yourself, I believe, will the trend continue? In other words, will the trend of increasing interest rates continue? Will the Fed and the RBA continue to raise interest rates, and at what rate will they continue to raise those rates? And then what are you going to do if that trend of increasing interest rates does persist? How are you going to manage that? Well, as I said, I'm going to be considering whether I include now PE ratios in my thought processes, but you need, of course, to make your own decisions about the sort of metrics that you take into account, and also decisions about where you think the global economy is going to be going with the geopolitical tensions and with the what seems to be an almost certain rise in interest rates. Well, thanks so much for watching at a time where inflation really does not yet seem to be under control, and so it's almost 100% certain that we're going to be having increasing interest rates over time as the central banks try to put a dampener on the march forward of this inflation. They just can't afford to let it run away. And so, the fact that the RBA put it up by 50 basis points last Tuesday, I think is a signal that they're taking inflation far more seriously than they did 6 months ago when they were talking about it just being transitory. Well, got that wrong, didn't they? Economists got it wrong. They thought the interest rates only go up by 0.25%. Wrong again. Really hard to forecast the future. So I do wish you the best with your investing, but I suspect we're going to be in for some tricky times as we move forward.